Hey guys, it's Seth, Paul, and Mo back here with Everything Money. We're glad you joined us again. We're talking about Amazon, obviously one of our favorite companies, one of the biggest companies. Paul, it's so incredibly easy nowadays to buy anything. My son reads a ton of books. I mean, with 2 swipes, it's coming in a couple days. I'm guessing we'll get to a point in the future where I can just think about what I want and Amazon will just deliver it about 3 hours later.
When we were kids, it was like, Dad, can I go to Walden Books? Can I go to Borders?
That's right.
I'll take you there this weekend.
Yesterday, I ordered some drain cleaner and some little things that go on the bottom of your chair. It took less time for it to come to my house ordering yesterday morning before the morning show than it would have for me to go to Walmart and come home and do it. It was incredible. It got there within 2 hours.
We're going to look at the financials, use our 8-pillar system. Say you've never looked at the financials of Amazon, but you've just seen this skyrocketing stock price and thought it's time to get in. Financial planners do this, Paul, actually, including my mother's who got her into Amazon.
Well, they're obviously financial experts because they can pick little ticker symbols and say they go up with the market and they say they're geniuses.
So instead of just picking them, let's look at the financials. We'll see how it translates into their stock price. We've gotten to this repetition, Paul, where people post in the comments, I already know it's overpriced. But the point is, folks, is we like to be professional reminders, and there are a lot of new people,
we want to show our process.
Yeah, it's all about process.
It's all about process.
Might as well do it with a fun company. Yep. Go ahead, Paul. Tell me about Amazon.
Guys, follow us on Instagram. It helps us out for some reason, I'm told by our marketing team. Okay, guys, so Amazon's a big company, $1.6 trillion market cap. Trillion.
Yikes.
So $1,600 billion. 5-year PE of 130 and a 1-year PE of 55. So guys, for a company this large to have this kind of PE, a little scary. 5-year return on invested capital, 7%. That's an X. So this is one we want less than 22.5X. We want this to be greater than 9%X. So far, not the best. Okay. So this is what this is saying is they're not using their capital to do very well, making a lot of money. Profit margin 6.6%, not bad considering gross margin is 25.5. I actually am surprised because they're doing more with Prime and AWS, and that's driving up the profit because before when they were just selling stuff, it was hard to make money. Income statement.
Pillar number 3 is revenue growth over the past 5 years.
Look at this, 150 to 443. They're almost as big as Walmart now. That's almost triple in the last 5 years. Almost triple. Pillar number 4 is net income growth. We got 1.92 to 29.44.
Oh
Holy
my
cow.
God.
Check, please.
Massive check mark.
Check, please.
Good for them.
Jeez.
Okay.
Pillar number 5 is shares outstanding. What are they doing? Buying back or selling?
Nope, they're issuing shares, 479 to 505. Not a terrible amount, but it's still an increase. Now, guys, this software, as you can see, is available. We created this because our users, our subscribers are saying, hey, how do I get the software? We put it together. I had a bunch of developers work on it. It gives you have a mobile app with everything you're seeing on a mobile app, all 8 pillars, over 30 years of financial data, stock analyzer tool. Guys, we give exclusive content that you don't get on YouTube, only on the app every single day. Access to all of us, real estate calculator, a phenomenal community of people who can discuss things, over 6,000 people. And guys, it's only 90 cents per day. This is a no-brainer. I don't care how old you are, this will pay itself over many, many times over just by learning the process and figuring out how to invest. Our competitors are $199, and $35 a month, and you don't get all of this with them. So this is a no-brainer, guys. If you're serious about making money and you're serious about your financial future, no-brainer, everythingmoney.com. Join us there. You don't pay sales tax, or you can go to Patreon. Costs a little bit more, but you get part of that community. Either way, click the link below. Pillar number 6
is total long-term liabilities divided by 5-year free cash flow. We want this under 5. So it's kind of confusing for normal people out there.
That's why when we describe it, I'm just going to say, guys, what I do is I go to our 5-year average free cash flow of $14.5 billion. I multiply it by 5, and that is $72.5 billion. Okay? I want their total long-term liabilities to be under this number. Why? Over doing a lot of research on things, this is the metric I figured out. Does that mean if it's over that it's bad? No, but just like everything in life, the less debt you have, the more likely you are to stick around. As Warren Buffett and Charlie Munger say, debt is something that can bury the smartest of people. Okay, so $72.5 billion. So how do I verify that? I go to the balance sheet. I scroll all the way to the bottom. $127.7 billion. So this is an X here for Amazon. We've had a lot of X's here at Amazon, right? Okay, so it has a lot of debt. Doesn't mean it's good or bad. It just has a lot of debt. Cash flow. Very simple here, guys. cash flow, free cash flow is cash from operations, less your capital expenditures. I added this line. You can't get this anywhere else to make the math easy for you. 7.63 to 7.07. That's actually an X. I don't know why their free cash flow dropped so much, because look at the last 2 years. So something happened in their free cash flow. Oh, they invested a lot. Look at this capital expenditure number. Look at that. Holy cow.
Mo, say that again.
They've been investing so much in airplanes and shipping. They're trying to just become self-sufficient in shipping.
So guys, this might be something you ignore. You don't care if the free cash flow down because they're investing a lot into capital expenditures to make their business better. I would go research what are they spending their capital expenditures on, because this isn't a bad thing. There's two different kind of capital expenditures. There's growth capital expenditures and maintenance capital expenditures. You should not care as much about growth capital expenditures. You should allow them to do that as much as possible. Why? Because they're doing that to grow the business. An example would be buying airplanes, building distribution centers, building factories where they can make more stuff to get more sales.
The shipping trucks that come to the house?
Yes, but maintenance capital expenditures would be things like replacing trucks, replacing roofs on buildings that they already have to keep it going. Those are the capital expenditures that you want to penalize them for. Now, the downside is most companies don't split out what percentage of the capital expenditures are either one of those. But you can sit there and see this big jump and go, okay, I'm okay with that. So to get a value in the company, $14.5 billion, we multiply it by 20, $290 billion. This is a starting point. This is obviously an X. The company's $1.7 trillion. Now, this is the hard part about Amazon. I'm going to focus on a stable Amazon when I do our stock analyzer tool. Because they're spending so much on capital expenditures, I want to focus on their earnings versus their free cash flow in this situation. But the question you have to ask yourself is this a company that's going to be able to grow the same level in the next 5 years they did in the last 5 years? That's a question you have to ask. Right now, the largest company in the world does $550, $600 billion in revenue. They're at 450. How much bigger can they get where it's going to be easy for them to get? I don't know. Are they going to become the first $1 trillion revenue business? Possibly. Question is, how soon? And that's what we do whenever we look at an analyzer. So when Mo goes to the chart, I'm going to start inputting the stock analyzer assumptions, and we'll go from there.
If you're interested in trading Amazon at a quicker pace, you can join Mo in his little kennel cough he's got over there.
It's driving me crazy.
What are people doing with Amazon? Uh-oh, look at that chart.
So the big thing is this gap that happened on earnings.
Gaps always fill, baby.
Gaps always fill, and you see how quickly it filled. I mean, this happened on earnings in August, and next thing you know, before mid-September, the gap had already filled. So that was very quick. Now, then it came right back down. But if we just take a peek over here at the daily chart, a little bit more detail, it is stuck below this 200-day moving average, and you can see that it has been, well, the majority of days I'm noticing are not hitting average volume on Amazon. And it's been quite some time since we consistently had hitting average volume. So again, volume is a problem in this market. Volume is the problem with Amazon right now. When volume does come into the stock, you will be able to go long on this thing. So if I was you, I would maybe just put a tracker share on this. Scratch that. It's $3,300 stock.
No tracker share.
Put it on a very tight watch list. Maybe separate watch lists. Have watch list A and watch list B. Put this on watch list A, and when this thing eventually turns back up and heads towards the sweet spot in the positive direction, that's when you can go ahead and get this, because this gap, I mean, it's going to double fill. I think it's going to come right back up here. This has been one of the stocks that's led the market up. So if the market goes higher, this one's for sure going to be leading that higher charge.
Paul, you got the stock analyzer tool. You are looking forward to this process. Tell them what they're going to get.
So people are going to immediately criticize my revenue growth numbers. They've done huge revenue growth in the last 10 years. I just think it's such a big company. We're going to do a couple of them. 8, 11, and 14% revenue growth. I'm looking at 10-year outlook, by the way, not just a 7-year. Share change, they keep issuing more shares, so I'm going to go conservative. Profit margin, I'm going to assume that on the high side, they actually beat their last year's profit margin, because as they do more AWS and more Amazon Prime, it'll increase. Same with free cash flow margin. I'm going to assume it's the same, even though they've done worse because of their investment. PE, 55 and price of free cash flow, 232. I'm going 14, 16, 18. Guys, a company this big, you can only justify high PEs if the growth potential is huge. Huge. Now, I'm going to hit the analyze button, 12.5% return. This looks bad. You look at this and say, I want to be paying around $1,100, $2,000 on the high side. Okay? So let's go up here and let's change some assumptions, because you guys are going to say, Paul, you're an idiot. Okay, I'm an idiot. 14, 18, and 22% revenue growth in the next 10 years. Just to let you know, that would take their revenue to $3.2 trillion in 10 years.
Currently 450.
Right.
Billion, 450 billion.
That's what I mean. It would take it to $3.2 trillion. The largest company in the world does $550 or $600 billion in revenue today. So it would make it 6 times larger than the largest company in the world right now.
Not probable.
Not probable. Okay? I'm going to still just assume that. It's still in the mid-level, not worth it. On the high level, assuming it becomes the biggest company in the world, $3.2 trillion, it's barely worth it. Barely worth it. So this is where I sit there and say, guys, I understand if you think I'm crazy, but these numbers, 22% revenue growth, that's going to be very difficult. 22% revenue growth takes it to $3.2 trillion in revenue business. Even if they're able to do profit margin that's better, I just don't see how it happens. Does that mean I'm right? No, I was wrong about Amazon years ago. I was like, there's no way they're going to grow this level, and they did. So what do I know? But the whole point is, if I have 100 companies like Amazon, I'm not going to do well buying them at these levels, in my opinion. Okay?
That's our take on Amazon. Fondle thumbs up. Join our community below. You can trade with Mo. You can join Mo in the morning at 9 a.m. Eastern. He talks about news and trading analysis. And we go live to all of you Tuesdays at 2 p.m. Eastern. The whole world. Paul, we get 600, 700, 800 people joining us every Tuesday. You can ask questions, and you can ask any question in our Everything Money community, and we'll talk to you there. That's our take. We'll keep you updated. Love Amazon. Not so much in love with the stock price at the moment, but we'll keep you filled in on that. Thanks for watching. Love you. See you.